4.2, responsibility statements for a merchandising business. We have 3 objectives. You need to be able to distinguish between direct and indirect expenses of a departmentalized business. You need to be able to prepare a departmental margin statement, and you need to be able to calculate and analyze vertical analysis ratios. So some terms that they're giving us: responsibility accounting is assigning control of revenues, costs, and expenses to a specific manager. Direct expense is an operating expense identifiable with and chargeable to the operation of a specific department. An indirect expense would be an operating expense chargeable to overall business operations and not identifiable with a specific department. Okay, a couple more. Responsibility statements. Financial statements reporting revenue, costs, and direct expenses under a specific department's control. Departmental margin is the revenue earned by a department less its cost of merchandise sold and less its direct expenses. Departmental margin statement then is a statement that reports that departmental margin for a specific department. And then gross profit, we should know this one is the operating revenue remaining after cost of merchandise sold has been deducted. So here they're showing us a departmental margin statement. We know that we're always going to have a heading, whatever statement that we're creating. So we answer who, what, and when. Here it says the operating revenue remaining after cost of merchandise sold has been deducted, and that is called our gross profit. So our gross profit is listed here. So when we look, we have our operating revenue section. We have our cost of merchandise sold section. Then we figure out our gross profit. And then we have our direct expenses. And then we have our departmental margin. A vertical analysis of departmental margin statement. So a financial ratio is a comparison between 2 components of financial information. Vertical analysis is reporting an amount on a financial statement as a percentage of another item on that same financial statement. So here what we're looking at is we're going to take the departmental margin divided by the net sales. Okay, the audit your understanding. Number 1, what 2 features are required if responsibility accounting is to be successful? Okay, 2 features then. 1, each manager is assigned responsibility for those revenues, costs, and expenses for which the manager can make decisions and affect the outcome of. And then 2, the revenues, costs, and expenses must be readily identifiable with that manager's unit. Number 2, for what type of account does Wiley have separate departmental accounts in the general ledger? Revenue, cost of merchandise sold, and direct expenses. And then last question, number 3, how are the vertical analysis ratios for departmental margin calculated? We calculate them by dividing the amount on each line by the amount of departmental net sales. So just remember, departmental net sales is always going to be your bottom number when you're dividing. You can now go on to the 4.2 work together video.